Daniel is asking, can I go over the reasoning of dividend stocks? Okay. So like I said, a company earns cash. Yeah? Like that's just generally with the point of a company. Otherwise, why would I would go work for a nonprofit, right? So company sells things. It costs them something to sell that thing, and they earn a profit. And then they either, that profit is cash, right? And it gets taxed and lowered, right? So either the company reinvests that cash into more stores, more factories, more websites, more, and grows the business. And guess what? When it reinvests that money, then it's tax-free. The company, if I own Amazon has like a zero profit, right? Well, because they're reinvesting all the cash into growing bigger and bigger and bigger and becoming our overlords, right? And all that money isn't getting taxed. But if they don't, like if they're a Philip Morris or there's something that isn't growing and doesn't really have opportunity to grow, then what are you going to do? What are you going to do with the cash? Well, now you have a book profit on the income statement that Mr. Taxman wants tax on, so you pay taxes there. And then you can either buy back stock, which I don't think is taxed at that level, or you can spit it out as a dividend. So buying back stock is a form of a dividend, because the less stock out there, the more percentage, the bigger percentage of that company everybody else owns. So, I prefer conceptually, theoretically, to buy back stock if it's cheaper, right? But dividends are really just for people that really don't understand. And because you get a dividend check in your brokerage account, that thing's taxed at your income tax rate, which is higher, not capital gains tax, which is lower. So that's just that. I mean, first of all, what is a capital compounder? What is a Tesla? What is an Amazon? What is an Apple? What is a Google? I'm talking about like way back around. It's the companies that have so much opportunity to grow bigger and bigger and bigger that they never spit out a dividend until they're uber big. Like Apple has a dividend. Yeah. Apple has a dividend that, because it's like so big, like how many more iPhones can they really make? But like Amazon still like got so much growth ahead of it. So yeah, that's just generally how we can go to it's just less preferable. And again, if you're going to go for dividends, why don't you buy bonds? Like you're basically looking for a bond, but in a sexier fashion, right? Or preferred stock or something like that. Thank you, Michael. I appreciate it. Yeah, that's what I mean. It's just, there's a lot of that. So anyway. Yep.
Hey, Justin, this is Michael Chen. Speaking about dividends, what do you think of dividend reinvestment? Like you automatically reinvest the dividend into the stock and then compounding the growth of your position. Is that like a real way to do it, or is that like actually a illusion? Thanks.
Yeah, absolutely. So thanks so much for calling in. Dividend investing, back to dividend investing. Dividend investing is romantic to people that are like newer, right? Or there's a reason why real estate's super attractive to people. It's because they love that they get like it's like tangibly real to someone to invest $10 and get 50 cents back a year. And they love seeing that cha-ching, cha-ching. It's the same reason why we love TikTok. It's like the same reason why we love slot machines. You invest your money and you get that cash flow, right? And when you get that cash flow, like there's some romantic in you, and it's the same with me, right? It's like, oh, if I could just find 5% yielding dividend stocks and I invest $1 million, I'll get 50 grand a year in dividend income. But it's also taxed anyway, I talked a little bit about the tax, how it's tax disadvantageous. But what you have to understand, especially as coming from like a CFO and an operator, so his question is, if I'm in dividend stocks, should I reinvest that dividend into buying more dividend stocks? That's the whole dividend reinvesting strategy. Yeah, but you're just approximating in a crappier way what a company already does for you. A capital compounder already does for you if you buy at the right price, right? Basically, you get taxed at high rates, you get double taxed, and then you get taxed. So you get taxed at the corporate level, and then you get taxed at like your income bracket level, and then you reinvest that taxed income. So you're lower already, and then you reinvest that. And then you do that all over again. You're like, yes, you're approximating compounding, but you're doing it at a really tax disadvantaged way. Secondly, those high yielding stocks are either REITs or they're companies that they're not going to grow very fast or much because they're most likely stagnant-ish or stable companies. And the beauty of it though, right, is when a good company with barriers to entry and momentum and market share growth is going to have the best reinvestment opportunities of anyone. And let me expound upon that. If I am the CFO of my company, I reinvest. So I'll address you in the money. I've already explained. First of all, there's I just told you why dividends are less advantageous. Secondly, like if I'm the CFO of a company and I want to invest, remember guys, you have a conceptual cash flow profit. Do I spit it out to investors or do I reinvest it? When you are a corporation, the whole point of your existence is to reinvest capital at a higher rate from your cost of capital, okay? So you borrow money at a rate from equity and debt holders and you reinvest it at a higher rate. And usually capital allocation projects have like a 3x to 10x ROI, right? What in your life right now can you invest in and say, this is a 3x, like I'm gonna triple my money by reinvesting? You guys don't have that. I don't like pick a stock, right? Like it's kind of hard. It's really hard because the market prices all this stuff in. But if you're a CFO or COO, if you're the C-suite of Amazon and you're looking at building a brand new factory, that their finance team is literally saying, what is the ROI, what's the payback period, and what's the IRR of investing in this new capital project? So finding companies that have those abilities to reinvest capital at 2x, 3x, 5x, 10x, 20x returns, let them do it. They're literally like, go let those those managers, like you have to believe in the management team, right? Some are incompetent, right? So that's why you have to believe in the management team. And two, but a company has inherent reinvestment opportunities that you just won't have. So there are multi levels why, if you want to screw with like dividend stocks, like it's not bad. Like you can compound your capital that way. It's just much less advantageous. So like, do I want to be in an Amazon? Like every dollar you put in a dividend stock that you don't want to live off of the dividend income, then why wouldn't you just go to Amazon? They've got capital allocation projects to grow. That's way higher than whatever you would do. So like, guys, cash flow and compounding are all the same. You're just slicing in different things, and dividends are like the most tax disadvantaged way to do it. So anyway, I mean, it's not necessarily that I prefer growth. Like I'm a value investor. You know that, right? That's what I'm saying. You're like in the money. I know you like trolling me. Like happy to have you on my show, man. Like you want to talk finance? Like let's talk finance. I actually come from a deep value. Like I came from distressed debt. So a lot of it was like vulture investing, deep value, like buying things at 4x EBITDA and like betting on recovery, that kind of thing. So I'm not actually a natural growth person. I started out in credit, which is the difference between growth and credit. So one end is growth, or one end is growth, one end is credit, right? Growth is like optimistic investors that are like, what could this thing be? It's a lot of like Nikola, a lot of like Tesla, like that kind of thing. And value investors is like, oh man, like if this company just can stay alive for 3 years, my money's paid back, right? Because it spits off so much cash at this price, right? If I buy something at 3 times EBITDA, all it needs to do is have 3 years with that EBITDA and my money's paid back and I own a company, right? That's value investing. Warren Buffett is somewhere in between, right? Like he does capital compounders, he's a value investor, but everything's really value. You're buying something at under the valuation of what you think it'll be valued in the future, or it should be valued, right? Everything really does boil down to value investing. It's just like once you understand the concepts at a native level, everything's the same. And why do you guys think I'm in real estate? Why do you think like an investment is an investment? There's just ROI. That's why I named it the ROIC Club. Everything is ROIC, return on invested capital. And it has different flavors. You can buy a house, you can buy a factory, you can buy a hamster that produces more hamsters, right? Like then you can sell those hamsters. Like everything in life, in investing and in finance, and is like return on investment. And just because you change the language up on me doesn't mean I don't fundamentally understand that it's ROI. Anyway.